Hello, traders. Welcome to the live webinar here. My name is Chris Svorcik from Elite Currency, of course, and we're going to take a look at our wave webinar, trade management in specific. So that means, once you're in a trade, how do you use waves to help you exit it at the best spot? Of course, entries is just part of the equation, something that traders heavily focus on, but exits just as important and something that maybe traders in general need to look into more carefully. Of course, it is tempting to look at entries and just focus on that, entries and strategies. But indeed, with exits, it's just as important, right? Getting a good entry price is only half the equation. Finding the best exit, the most adequate exit, is very important in terms of having patience to go to the full target, or finding the right spot to bail on the trade, or finding the right spot to cut the loss, or take the profit. It is an art that needs to be studied as well. And of course, we can use waves, price swings, fibs, fractals, moving averages, just like we do for entries and understanding the chart analysis. We can use the same methods for understanding trade management. Generally speaking, there are two types of trade management: passive and active. Where passive, you just set a stop loss and TP and do nothing. And with active, of course, you're looking at new information as the charts go along. I'm in favor of active, but of course, passive is easier. So we'll take a look at both. Before we do that, though, quick intro to Elite Currency website. Here you find it. You can join us for free on Telegram. But specifically, if you're interested in our services, go to services, then Forex and CFD or options, or tools and strategies. Or if you're interested in some free information from us, blog, education, webinars, we have it here below, research and education. Specifically, if you're interested in more information on trading, how I do with moving averages, Fibs, fractals, and price patterns in general, then I think SWAT is a good course for you. There's 70 videos with 22 plus hours and methods, 500 plus page ebook. There's strategies and just a lot of good educational value. But if you think that the price tag is a little bit too pricey, then you can also just start with the SWAT guide, which is for only 24 euros 95 cents, and it gives you a full ebook, gives you a very good understanding of how to digest the charts and get the most out of them. All right, in my view at least, dives into technical analysis and price patterns. All right, now off to our target, off to our topic of today, trade management. And I'm going to keep it practical and look at charts for that. So, as I said, we have two types of trade management. So with active trade management, for instance, we're looking at the Bitcoin BTC versus the dollar right now on this chart. So let's say that we're looking at an ABC pattern here, and we see a bounce up and a hook back and this pullback not breaking this bottom. And we trade, for instance, let's say we enter here upon the break of the 21 EMA, okay? Because we have a higher low at that point. We have a completed ABC pattern. Of course, the BTC at that point was in an uptrend, very clear established uptrend. And so we have an uptrend, we have a break of the trend line, we have a break of the 20 MA, we have an ABC pattern completed, we have a higher low, and we're re-breaking above the 20 MA, all moving averages aligned. So let's say we enter here, just for hypothetical purposes, okay? So, and we have a target that still hasn't been reached. Let's say we have a TP at, I don't know, $95,000, for instance, okay? And so a passive trade management style would be to place a sell order, right, at around 95,000, let's say, where you have your target. Put the stop loss wherever let's say in this case, we'll put the stop loss a little bit below 25,000, maybe, give it a little bit of space. We could have used this bottom, but I don't think that is that good. But in that scenario, right? So let's say we would have used the supply and demand zone here, put the stop loss below there at around 22,000, 300, for instance, right? So that's about $11,000 stop loss. If you are using stop losses, of course, with trading with leverage, of course, you have to. If you're trading just with no leverage, it's not even necessary. But with leverage, it is a must, of course, because of the risk involved. And we are looking at trading here purposes, so I will assume a stop loss, of course. And the target is about 62,000-ish, right? So it's about 5-to-1 trade, I guess, or 6-to-1 trade. So that would be set and forget, passive management, no interaction here. But with passive management, or with active management, excuse me, that is passive management. With active management, of course, we're using the information that arrives to make decisions, right? Do we move the TP further or closer? Do we trail stop loss, use a trail stop loss to reduce the risk? Do we move to break even? Do we lock in some profit at a certain spot, or do we take a market exit, or do we close part of the position in a profit or in a loss? So these are all decisions we do after the entry. And well, the advantage of passive management is that it doesn't require any time, so it's easy to implement. That said, the advantage of active management, of course, is that we can use the new information that arrives, because after entry is done, new candles form, new patterns form, and we can use that info to make better decisions about a trade from the past, right? At this moment, the trade made sense. But maybe as new candles arrive and new patterns form, that trade idea, that probability of that trade idea working out goes down. So with active trade management, we can actively intervene on that information, whereas with passive trade management, we can't. That new information we have to purposely ignore. So I think that active trade management is better, but more difficult, because we can use that new information to make better decisions. The trick is, though, and that's why it's more difficult, is that people in general, and traders, of course, are not exceptions to that, tend to overreact or underreact to new information. So as new information comes along, they either misread that information and act too soon, or they're too late and they underreact to it. It's difficult to find that fine balance between the two, and that's, of course, ideal. If we can find that fine balance, then that is very important in successfully applying trade management. Let's take a look at some practical examples. So here, for instance, we see price falling, right? We see it first going our way and then falling very quickly. So it could be very tempting, as you can imagine, to, at that point, maybe overreact. We first see it going our way. We feel very confident. This is all, of course, very much connected to trading psychology. And we feel very confident about how price is moving to the upside. And then that confidence just disappears like snow in sunlight, right? In sunshine. It totally evaporates as price is falling, and we feel disheartened, and we might exit the trade as it falls back to our entry, maybe taking a loss or closing it around break even, because we think it's going against us, and we kind of overreact to that, rather than maybe waiting a little bit, giving it a little bit more time, and seeing how it evolves without rushing into that kind of conclusion. As you can see, in this case at least, price bouncing at the 20-MA again, it's a break pullback continuation pattern, and just keeps pushing up, right? So that was an overreaction. That said, we might take a look at this current situation as price is pulling back, and if price breaks through, a fib, like for instance, if it starts falling a lot below the 61.8 fib, and I would do nothing, I would consider that almost underreacting. I mean, I think the chance of Bitcoin doing that is very small at this moment. But of course, there could be moments where not reacting is the bad decision. Let's maybe take a look at some example. Maybe Let's say I took a counter trend trade here at the previous tops, the previous double top here, and I see a price is not breaking the 143 MA. Well, in that case, maybe just hanging in there and not reacting is bad, because there is a fair chance for price to break out, and that's what it did. So, you I think want to find that balance with not reacting too quickly, but also not reacting too slowly, specifically with reversals, but actually in all cases. So that would be an example of reacting too slow. This would be an example of reacting too fast. Now, in this particular scenario, let's say in this hypothetical situation, if I'm still in that long, right, then what would be an adequate way of trade managing this long on the Bitcoin BTC USD? Well, if this is indeed a wave 3 and we're getting a wave 4, then I think certainly moving to break even is a fair decision, right? There's nothing, I don't think price will ever go that deep. So specifically in this momentum up. So I don't think there's anything wrong with going to break even if you're trading this with leverage, right? Or even locking in some profit, maybe going below these tops, I think is certainly a fair approach and balanced approach. Anything tighter, I think, could be maybe pushing it a little bit and could be a bit too aggressive. But if you really want to lock in, if anyone wanted to really lock in profit, of course, it is also still a fair option to go below the 38.2 fib. You might get stopped out of that trade a little bit sooner than you would like, but it is not unthinkable that that could be a reasonable option if you really wanted to use a tighter stop loss. Price has already bounced at the 38.2 fib, so it's a fair approach to use the candle low now at the 38.2 fib for a tighter stop loss. So I would say this is a variation that is tighter, a tighter kind of approach, but still a balanced approach in the sense that price has bounced at the 38 fib. So I think it would be still a fair kind of approach to do that, although more more tighter kind of view. Within the range of options, I think going below the double bottom or at break even is probably a little bit more looser approach, and but it's all within the range of options at this moment, right? I would say that none of these options are necessarily over or under reacting. I think they're fair. It depends a little bit on the trading style and aggressivity of the trader in this case, and how much he thinks, how likely a trader thinks that this is going to go up in the near future, right? So that's an example of Bitcoin. So I think it's important to find that fine line, and I think that using my model of four-step model, where you have, which I explain in my SWAT ebook and my SWAT course, which is basically having patience at the start. There are 4 phases: patience, and then phase 1. Phase 2 is trying to cut the loss or moving to break even. Phase 3 is patience again, and phase 4 is trying to get as much as possible out of your profit. So phase 1 is all about sitting on one's hand and letting the trade develop, really. If there's a reason for entering a trade, then 1 or 2 candles later, there shouldn't be a reason to exit that quickly, right? Typically, there should be at least a couple of candles. We should give it a couple of candles the time of the same time frame, and we shouldn't zoom into lower time frames because that messes with our minds. We should give it a couple of candles at least. I think at least 5 to, if not 20 candles for just the trade to develop, right? Because if we're entering on an hourly chart and then we zoom into a 5-minute chart and 20 minutes later we're exiting, then maybe the reason, either we're overreacting, probably emotionally, or the reason for entering was not strong enough. Either of the two is bad. There should be, when we enter, there should be a strong enough case for us to be patient enough to let it develop, right? Then as it develops and we get new information, sure, then we can leave phase 1, we can leave the patience phase and go to phase 2. And that's the moment where we want to be a little bit more aggressive into reducing the risk, moving to break even if possible. So let's give an example in the Eurodollar. Okay. Let's say I entered at the 61.8 fib, right? I was talking about the ABC down. So then expected a bounce at these fibs. We see bullish price action here. So let's say I entered along, somewhere here around 120.39. Now, do I want to give up on that trade if after a few hours it doesn't go anywhere, right? No, I want to give it some time. Wanted to give it some potential for the trade to develop, right? If I exit a few candles later, it doesn't give it time. You can see it moves up on my way. I didn't give it time to mature, to give it a chance, right? But as price then goes my way, of course, then I can think about phase two, which is maybe cutting. Let's say I had the original stop loss below the 78.6 fib. I can move the stop loss to these bottoms or to break even as price heads up, right? So at that moment, there's no need to keep risking as the trade has clearly made a move into my direction and established itself. And yes, I can cut the loss short or move to break even, etc. Then I see the break above the long-term moving averages, and I can think about even locking in profit, maybe using a trail stop loss below the fractals. Eventually, maybe even using a trail stop loss below the candle lows, locking in as much as profit as possible. Or maybe placing a TP at the previous tops, right? And taking a nice exit there. But let's say I don't have a TP. Let's say I have a TP higher. So after, basically phase two is moving into break even. So phase three is giving it again some time, right? Now that it's clearly established that it's going my way, I can try to give it a little bit more time. Try to see if it can push a little bit further into my target zone. So let me see if I can find another example. Let's say I took this breakout. I entered, let's say I entered somewhere here before the breakout happened. I give it some time, or I can even enter here. Let's take this example of this breakout candle, right? Here. So after, after a few candles, it doesn't go anywhere. I don't want to move too fast, right? First 6 candles, price doesn't go anywhere. It's around break even. I don't want to prematurely exit. I want to give it time to develop. Then it goes my way. So as it goes my way, I can think about at least moving maybe the stop loss to this fractal. And then when it goes again into my direction, I can think about going to break even, for instance, right? So phase one for the first candles, phase two, as price kind of at least partially goes in my way, and then phase three enters here in this zone, where I want to be again patient and not cut my winners short, right? I want to let my winners run. Let's say I have a target here somewhere. So I want to give it time for price to reach my target. But eventually we can start thinking about phase four as price makes another consolidation zone. I have given it some time already to reach the target, but I don't want to give it too much time either. So I can think about maybe some type of trail stop loss, not leaving it just at break even, but maybe using these fractals to lock in some profit, and this fractal, and then once it starts falling again, I could even use a tighter trail stop loss above these candle highs, and in this case, it hit the TP, but if it doesn't, I lock in more and more profit. So that's kind of a great way of giving it time. Right here in this phase here, I'm patient. Then I try to move. I reduce the risk, move to break even. I give it time. Phase three, I give it time for reaching the target, and eventually I go into phase four, where I want to lock in as much profit as possible. So this is a winning example. Of course, let's maybe take a look at the trade idea where things are going more difficult and where the trade is going against me. All right, so let's say I take a long in here. All right. So I first see price, let's say maybe a little bit earlier. hang on here, for instance, right? Okay, I see prices breaking above the 21 EMA. ABC up, ABC down. I might think there's another ABC up going at this moment, so I try that. Price goes my way, goes against me, goes with me, then goes flat. So I have been patient for a while. And then, but it's not really going my way that much, right? Then I see price starting to break below here. So I think that, anywhere, either after a few candles or as it breaks below the 20 MA, it's fair to think about some type of trade management to reduce the risk. Let's say the stop loss was here. So I could, for instance, think about moving the trail stop loss to at least below the 20 MA and the 144 MA like this to reduce the risk, right? So not cutting the loss short. So that's always kind of the motto, I think, with trade management. It's cutting the losses short when appropriate, and letting the winners run when appropriate, and catching the profit with winners that are seemingly running out of steam. I think that's the fine balance for optimizing the potential by cutting the losses as much as possible and letting the winners run as much as possible, right? I'm not saying that it's impossible to make a exit earlier than within the first few candles, but specifically with reversal trades. But that said, it's a fine balance. We want to give it some time typically for a trade to mature, unless it's a very risky trade and we're purposely exiting sooner. For instance, let's say we took this trade right here. We took this breakout after a pullback. We see price immediately go our way. So yeah, we're patient. We can go into phase two and move to break even. And then we see the break above the 20 MA pullback continuation. So yeah, in that case, makes sense to grab as much profit as possible and use the trail stop loss above this fractal at the very least, or even maybe exit at the 21 MA. Let's see if we can find a different example. Let's say we took a short setup here. A reversal, a short, bearish engulfing twin, but price is making a bull flag pattern. So of course, at that moment, it eventually makes sense to be more cautious and not to let the trade run forever and try to cut the loss short when the break happens to the upside instead of the bull flag pattern, or even maybe cutting the trade when we see the bull flag or when the bull flag breaks at least. So those are some trade management decisions when the price is going against us. This is not overreacting. This is reacting in time against something that's going against the trade idea, right? So not saying that reacting fast is bad, but we want to do it appropriately at the right time and not overreacting, because we got to find that balance, I think, because you don't want to overreact to something too soon, because that could cut your losses. You could cut your winners. That said, of course, if there is tangible evidence that the trade idea is not developing as we expect, then it is, of course, good to cut the potential loss. All right. So we can use wave patterns to assess the situation better. So, for instance, with this upside, we can see there was strong momentum here against the trade idea. So that's typically wave 3. So if we see chop and price action to the downside, it respects the 21 EMA. That's typically wave 4. That's good information to cut the trade to the downside, right? And be careful. So we can use that wave information for our purposes. If we see price breaking through the 20 EMA here, that's good information that maybe the ABC up is finished and we're back in a downtrend, in fact, rather than an extended upside. So that's how we can use a breakout and waves to our advantage. if we're looking at a bounce at the 143 May for one more wave up, then we might be careful about the target because we know that waves 5 don't typically, they can be short. They can break the high and then make a retracement back down again. So having a tight trail stop loss as price moves up, or a short target, a short TP, makes sense. Using that info with waves makes sense for the trade management. Whereas with wave 3, the break of this bull flag, right? Although we're not sure that's a wave 3, this could have been 1, 2, 3, 4, 5. So maybe still aiming for a TP makes sense here. But if you anticipate an expansion of the wave 3, then yeah, using a trail stop loss and not cutting the trade too short could also make sense here. Let's take a look at this fib. So 1, 2, 3, wave 1, 2, 3. So we expect a wave 4. So obviously, let's see, how can we use that information? So of course, if we're in a short, we can put the trail stop loss safely above the 50 fib or safely above the 38.2 fib and trail stop the fractals, because we know that if this is a wave 4, it shouldn't go much deeper than that, specifically if price has already bounced at that fib. And after that keeps going lower, well, of course, in that case, we can use trail stop loss below those highs to reach the minus 272 target. So all the rules and information we have from wave patterns we can use to determine the likelihood of price continuing in our direction or not continuing, and thereby using that information, of course, for active trade management decisions. All right. So that's it for now. If you have any follow-up questions, of course, feel free to ask in our live webinar 2 weeks from now. We can discuss more then and there. But that's it for now. Check out the SWAT ebook or SWAT course, of course, if you want to know more about my methods and wave and chart patterns in general. And wish you all great trading. Cheers. Bye-bye.